We believe that the risk of a double dip is small. There is a little bit of a risk for a double dip, but the risk is pretty small. And to be honest, for the core sector on which we are focused on, we think that will probably postpone the development of the market, growth of rents or the investment market, but it won't have a big effect. The only issue we may have is if there's a major event coming again, like another Lehman crash, and that will have an effect to the US real estate market as it would be for the European markets or Asian markets. So the question is very much, is there anything out there which causes a major event and therefore has an effect to the real estate market? We don't think so.
Even though there's not a double dip in the US, we still have a 9.5% unemployment rate, which seems to be stuck at 9.5%. And you know, obviously this affects retail, affects offices, and how do you reconcile this unemployment rate?
I think that's one of the reasons that the core space has received so much investor attention, is because people are looking for that degree of safety and security initially. They're looking for in-place rents, and we all just need to be very careful on how do we underwrite those rents. I think generally speaking, investors are cautious about their growth assumptions. In some sectors, in some markets, investors are still marking down rents as the beginning point, but it's a phenomena that I think has pervaded the investment market in a sort of a cautious approach. But I must say, in light of that caution, every quarter that goes by, we're seeing fundamental improvement.
Our highest occupied market in the country right now is Phoenix at 98%. Most people hear Phoenix and say, okay, it's a disaster, and a lot of it is. I mean, the average retail occupancy in Phoenix is in the upper 80s, but if you have the right selected retail in the right locations, it can do well. Vegas, we're at 94%. So again, it's underwriting and really understanding the real estate and having the right types of properties. And if someone has a lot of lifestyle type centers, they were kind of the showy, hot thing a few years ago. Well, those centers are really getting decimated because when tenants don't hit their sales targets, they can leave, which then triggers another tenant leaving, etc. So it's also the type of retail.
Okay, can you explain a lifestyle center?
A lifestyle center would be, might have an entertainment component with the theater, may have some very high-end expensive restaurants, some high-end fashion retailers, and those are the segments that are getting hurt. The grocery anchored, Kroger is up. Kroger's a large shopping supermarket chain in the U.S. I mean, their sales are up 3% year over year. We've seen deals where rents are 20% above market, and we've seen deals where rents are below market. And sometimes it's tough to evaluate what others are thinking on their underwritings of those.
I think it will be important to stay disciplined as being a real estate investor to say, okay, this pricing makes sense, and maybe other pricing levels don't make sense.
In other words, you're looking at a 10-year investment. You're looking at a low yield today, but 5 years from now, that yield's going to look a lot better.
I think there are 2 points. I think the initial yields, even though they seem low to some real estate practitioners, are rational in many respects relative to alternative investments. And secondly, and again, this is very property and market specific, there is more growth available in many of these assets that people are buying today.